Everyone is in complete denial about the pain we are going to be facing and is coming our way. While everyone thinks that 2020, 21, 22 was the worst of it, no, we're about to pay the consequences for all the bad and terrible decisions we've made. So you don't want to be like the sheep and go along with the herd right now. You need to wake up, pay attention, look at the data, look at the facts, and prepare your family and get your house in order right now. Because while we're about to face some severe pain ahead, through every crisis, there is always opportunity. So everyone, what pain is coming? What are we going to be facing coming ahead? Well, that's exactly what I'm going to go over in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, okay, first things first, I'm sure you've all heard of this, but this is just the first piece of the puzzle, and I'm about to get much more in depth on a lot more indicators, everyone, on what's going to happen in the markets, what's going to happen in the economy, and ultimately what's going to happen for your family circumstances. To look at this, they were saying we're facing disinflation. Well, inflation flipped again like I predicted. Inflation rose 0.5% in January, more than expected, and up 6.4% from a year ago. So that's right, we had Jerome Powell come out early this month. We had 0% inflation, then minus 0.1%. And he was saying, look, hooray, we've won the inflation battle. We're now having disinflation. And I tried to warn everyone, no. Prices are still going up. They had to revise 4 out of the past 5 month CPI reports because they were severely underreporting how much the real inflation rate is. And even with these new reports, it's still severely underreported. But what we have now is, even with the CPI data, they can't hide how bad inflation still is. So let's break it down piece by piece to see what items are rising the most and what items are now starting to fall according to their data. Okay, everyone, we have it here broken down by sector. We can see here food in January increased 0.5% and it's up 10.1% over the past 12 months. Look at this. Energy is now making a comeback, up 2% in the month. That's up 8.7% year over year. Also, we can see here utility gas prices. I know everyone is commenting that their gas bill is going up so much, especially in California. Definitely time to get out of California there, everyone. That's up 6.7% in just a month. That's absolutely insane, and up 26.7% over the past year. And I'm sure some people have said they've seen a threefold price rise. Now, what's very interesting is used cars and trucks. According to this index here, they've actually fallen 1.9%, but according to the Manheim index, used cars and trucks actually rose in January. So there's some conflicting data here, and if it showed that used cars and trucks actually went up, we would have a much bigger CPI print. And like I tried to warn everyone, the used car market was in a bubble. It's down 11% over the past year. We can see here medical costs up 1.1% over the past month, so that's quite alarming. Shelter now makes up a very big part of the weighting with the new CPI weighting, and that's up 0.7%. We can see here apparel's up 0.8% as well. So Jerome and the markets were dead wrong, and inflation is still here to stay. They've been saying that don't worry, it's a transitory, or maybe, it's just a long transitory inflation period. Well, no, everyone, like I keep harping on about, they're going to have to live interest rates above the inflation rate to bring it down. So, unlike what the market's thinking, I think we could now see interest rates over 6%, because I'm seeing the new strategy now so people don't panic. What they do is, well, okay, everyone, what we'll do is we'll lift interest rates to 4.75%. The next month come out, oh, actually, inflation's worse. Okay, we'll lift it to 5%. Then the next month, oh, what's that? Inflation's still worse. Okay, we'll lift it to 5.25%. And now we've got this inflation report. Oh, what? It's still bad. Okay, we'll lift it to 5.5%. Can you see here? They won't actually tell you the destination they're going to have to go to, because if they did, everyone would be in panic, because they know if interest rates go above 6%, the whole economy and this debt-based system will implode. So they have to keep on saying, don't worry, everyone, just another 25 basis points, just another 0.25%, just a little bit more, just a little bit more. Don't panic, don't sell. Well, before you know it, people will be at 6% all the way from zero. I know what you're thinking, well, shouldn't high inflation be good for stocks anyways? Well, history has shown it actually hasn't been. And look at this chart here, everyone. We can see here, consumer price index for all urban consumers, the purchasing power of the consumer dollar in US city average. And we can see here, ever since 1947, your purchasing power has been absolutely collapsing and is now down over 90%. Now, the reason why high inflation can actually be bad for stocks is because what it means, it's higher input costs for companies, and it can take up to 4 quarters for them to fully pass on those higher input costs to customers. So what it does is it squeezes companies' margins, their profit margins, and this is what we're seeing lately with companies' earnings reports. Their margin is being hurt. They're saying they're being hit by high input costs, but they don't want to directly increase the prices straight away because customers will panic. They'll go to another competitor. So they're slowly passing on these costs quarter by quarter. Also, what you have to pay attention to with the stock market returns during periods of high inflation is real returns. In real terms, you've actually had no gains. Now, what also happens during periods of high inflation for the stock market, growth stocks get hurt much more, but value stocks hold up much better. But this is just the first piece of the puzzle, everyone. We know inflation's getting worse. We know interest rates are going to have to go higher. And later in the video, I'll show you some proof from a few Fed officials that they're saying interest rates are going to have to go even higher than the market's thinking, much higher. But we need to have a look at a few other indicators that shows us the stock market is still overvalued and we could be facing up to another 30% crash. Let's dig a bit deeper, everyone. So first things first, everyone, is the yield curve. Now, this has been inverting, but it's actually now at its steepest inversion it's been in over 40 years, minus 0.83%. So we could see the yield curve invert by a full 1 percentage point. Now, every single time there's been a recession, the yield curve is always inverted before that recession. So if normally inverts a little bit or briefly and we have a recession, well, if it's going to be inverted for this long and this deep, what does that tell you? It tells us that this recession we're going to be facing is much worse than the market's pricing in. Now, indicator number 3, something I'm hearing in the markets is you got to buy the dip. Stocks are so cheap. They're on a discount. Get it while it's low. Well, people, by historic standards, stocks are still severely overvalued. Look at this. So this is the S&P 500 price to earnings ratio. And we can see here, the medium is 14.9, and right now we're at 22, much higher than it's been throughout history. And we can see here during the 70s and 80s, when we had a period of high inflation, it actually fell all the way down to a price earnings ratio of 7.5 to 8. So in order for us to get back to the medium, we'd need to see the stock market crash by 30%. But I know you're thinking, Michael, that's just one indicator. Well, I've got another indicator for you to show the stocks are not cheap, they're still severely overvalued. This, everyone, the Warren Buffett indicator. This is the stock market value compared to GDP. And right now, the stock market is valued 170% compared to the US GDP. This is 32% higher than the long-term trend line. So the price to earnings ratio is a very good model. And Warren Buffett, the greatest investor of all time, a lot of people thought maybe Cathie Wood in 2020 and 2021 was going to outrank him. But we saw, everyone during a bull market is a genius, but only until the tide comes out. You see who's been swimming with no undies, and she got exposed. So that's indicator number 4, but we still do have much more indicators that show us there is going to be a severe recession coming, and there's absolutely no way we can avoid it. So indicator number 5, everyone, the personal savings rate. This is near an all-time low. So what this tells us, if people have some kind of economic shock, they're really only one paycheck away from financial ruin. So they are not going to be able to weather the storm like they could during past recessions when they had a much bigger savings buffer. Indicator number 6, total consumer credit. Look at this. This is absolutely going up like a rocket ship, like a skyrocket. This is what's really going to the moon, not stocks, everyone. This has hit a record high of 4.7 trillion. So if people's savings are at all-time lows, their debts at record highs, how are they going to keep on spending if the price of goods keep going up and up and up? Newsflash, everybody, they aren't going to be able to spend. And so companies' earnings are going to get worse. This means, like what we're seeing with a few earnings reports where companies like Lyft, they crashed 30% overnight. We're going to see more and more stocks crash overnight during the next round of earnings reports. Because we just got some more breaking news to tell us that inflation is going to be worse. And we've also got some new comments from some Fed officials to say interest rates are going to go much higher than the markets are pricing in. For this, everyone, OPEC output drops as Saudi production falls by 156,000 barrels per day. So we just had Russia cut production by 500,000 barrels per day. Now Saudi Arabia, yes, Joe Biden has tried to offset this by releasing another 26 million barrels of oil from their strategic oil reserves, but this is going to be short-lived. They cannot keep draining these strategic reserves, especially when geopolitical tensions are so high right now. Because what the market is pricing in right now, they're pricing in perfection. The markets are pricing in there's going to be no recession. The markets are pricing in the earnings are going to hold up. Unemployment rate's going to stay low. People are going to keep on spending. The Federal Reserve is going to stop at 5% interest rates. We just got new comments from them, like I said, that no, interest rates are going to go much higher, so buckle up everyone. So listen to this, Fed officials float even higher rates after brisk inflation data. New York Fed President John Williams said Tuesday afternoon that having the federal funds rate in a range of 5% to 5.5% by the end of the year as listed in Fed officials estimates in December is the appropriate framing. And economists at Barclays and Monetary Policy Analytics now see the Fed lifting rates to a range of 5.25 and 5.5%. So like I've been trying to warn everyone, they're going to lift interest rates. They say now, okay, 5.5%. We all know the trend here. Every single month, they just raise it by another 25 basis points. We know they're not going to be able to stop inflation until they lift interest rates above the inflation rate, because this is what they had to do throughout history. That's why they had to bring Paul Volcker in to lift interest rates to 20% to bring inflation down when it was at all-time highs in the 70s and the 80s. And if we actually use the same method they used in the 80s to record inflation, the inflation we're experiencing right now will be just as bad compared to then. And nobody's asking the obvious question, what happens if inflation doesn't go down? What happens if they have to lift interest rates to 7% to stop it? While people with debt at these record levels, with consumers having no savings, we're going to see spending absolutely come to a halt. We're going to see people unable to take on more loans because they won't qualify with these high interest rates. Companies' earnings, like I said, are going to plummet. We're going to see companies go bankrupt because they're not going to have the revenue come in. They're going to have to pay more interest on their debt, and we are going to face a huge recession. And if we have some bank failures or some huge company failures, we could have a full-on financial crisis worse than 2008. And this is all because every single time we've had a recession, the central banks have come in there, printed money, lowered interest rates, kept the zombie economy going, kept these zombie companies going, and made the bubble worse, made the problem worse. And now it's time to face the music. There is no get out of jail free card. There is no getting out of this. There is going to be pain either way from high inflation or having to lift interest rates to stop it. So everyone, like I said, you're going to want to prepare right now, get your house in order. Now, what has actually outperformed during periods of high inflation, like the 70s and like the 80s, is actually gold. Look at this, everyone. This is a chart of gold going all the way back to 1973. Now we can see here it was around $100 per ounce, and we can see here during the 70s all the way up to around the 80s, it skyrocketed all the way to around $800 an ounce, so up around 8x. So what I'm doing to hedge against this inflation crisis, and so I don't lose too much of my purchasing power for now, I'm just dollar cost averaging into gold and silver, and I'm waiting for the real crash to come in the stock market, because I don't think we've seen the bottom yet, and I think there's going to be much more deals coming. But everyone, what do you think will happen to the stock market this year? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.